This video is for you if you make a really good W-2 income and at the same time you want to throw up a little bit this time of year when you're filing your taxes and you think about how much of your hard-earned money that you're paying to the IRS. I'm going to show you exactly how to use one of the biggest tax reduction strategies that exists to eliminate a huge amount of your taxes, if not all, and at the same time own an awesome short-term rental property that's going to pay you every single month forever. And this is repeatable every year so that you can eliminate taxes every year while building significant income and financial freedom. My wife and I just recently filed our 2025 taxes, and we ended up owing less than $1,000 in federal income taxes, even though we made more than we've ever made in our entire life this year. And had we not implemented this strategy, we probably would have owed over 6 figures to the IRS. But instead, we kept that money and we put it into high-performing short-term rentals that will pay us for years to come. And I've worked with hundreds of other people to help them implement this exact same thing. So the strategy that I'm going to walk you through in this video is sometimes referred to as the short-term rental tax loophole, but it's not really a loophole. It's just a massive tax incentive that the IRS gives you to invest in short-term rentals. And if you buy the right one, you're not only getting a huge tax write-off, but it can also be a super profitable, high cash flowing investment at the same time. I've done a couple other videos that really explain the details of how this strategy works. If you want to check out this one or this one, you can click on the little interactive link that just popped up at the top of the screen, and I'll also put the link to both of those in the description below. But in this video, what I really want to talk through are the biggest mistakes that I see people make when they're implementing this. Because you can go through all the stress and effort to implement this, but if you get the details wrong, you might end up with a great property, but you miss out on all the tax benefits, which is one of the biggest bonus benefits that come with this strategy. So just to provide a really quick understanding of how this works before we get into the mistakes, last summer, as of the signing of the so-called Big Beautiful Bill, the IRS now allows you to buy a short-term rental and write off a huge portion of the value of that property against your active income. So this is not something you can do with long-term rentals. You can't write off the depreciation of a long-term rental against your active like W-2 or 1099 income. But with short-term rentals, it's considered an active business. So you can write it off against your active income. And usually it's about a quarter to a third of the value that you can write off, a quarter or a third of the value of that property. So if you buy, say, a $600,000 property like we did last year, you're probably, depending on a few specific factors of that property, you're probably going to be able to write off $150,000 to $200,000 against your active income. But in order to do this, you have to follow a few rules and not make these big mistakes. So here are 7 top mistakes that I see investors make when it comes to using this strategy. Mistake number 1 is failing material participation without even realizing it. So the IRS says that in order to take advantage of this strategy, you need to materially participate because this is considered an active business, which is why you can write it off against your active income. And so they've set the bar for what materially participating means pretty low. So there's 7 different ways that constitute material participation, and you can choose from any of these 7 that the IRS lays out. And so for most people, the easiest one to meet is to just participate in your short-term rental activities, which is a pretty broad scope, but to participate at least 100 hours throughout the course of the entire year. And that 100 hours has to be more than any one other person in the business. So the big mistake that I see a lot of people make is they're like, oh, I'm working hard, I'm busy, I'm going to go out and buy a short-term rental to write off all this W-2 income that I'm making, and I'm just going to go buy the property, hand it off to a property manager, and then, I'm good, and I'm going to write off a huge portion of that. You're not going to qualify because a property manager is obviously going to spend more time on it than you. Even if you spend the 100 hours, it's hard to justify that property manager isn't spending even more time on it than you. And so you need to track how many hours you're actually spending on it, and you can't just hand it off to a property manager. So we have a kind of a hybrid system where we're not handing it off to a property manager, we're self-managing, but we strategize on how to hand off different aspects of running that property to different people so that nobody's going to exceed your hours, but you don't have to spend a massive amount of time on that property. So mistake number 2 and mistake number 3 really tie into this idea of material participation as well. And mistake number 2 is buying a property in like November or December. And so the material participation clock doesn't start ticking because you start thinking about or researching short-term rentals. You can't apply that time, that 100 hours that you need to meet. And so if you're like getting toward the end of the year and you're looking at your tax situation, you're like, oh, I got to get this huge write-off. I'm going to go out and buy a short-term rental. It takes a little bit of time to line up the right deal and get it purchased, there's a closing window, obviously, and then get it set up and then get it booked out. It has to actually be a short-term rental. You can't just close on a property on December 31st and say, that was my short-term rental, even though I've never used it as a short-term rental. So the earlier in the year you can start planning for this, the better. People have gotten it done toward the end of the year, but it just adds so much more stress. So if you're on track to need a significant write-off, like if you're making good money, start this process toward the beginning of the year or middle of the year, and it gives you so much more time and lower stress when you're implementing this strategy. Mistake number 3 is just assuming that you're too busy to implement this strategy and meet this material participation requirement. And it makes sense because a lot of people who are high income earners have a very demanding job, right? And so you're not going to have a lot of flexibility or extra time, most likely. But what a lot of people don't understand is that 100-hour requirement for material participation actually can be between you and your spouse. So a lot of times the spouse might have more flexibility, or if you're both busy, you can each put in some time here and there throughout the course of the year. And so it cuts that time in half if two of you are working on it together. Because if you're married filing jointly, the IRS looks at you as one entity. So as long as between the two of you, you can hit the 100-hour requirement, it doesn't matter who puts in more hours. You just have to hit that 100-hour requirement, and it has to be more between the two of you than any one other person. Mistake number 4 that I see people make is that they don't understand the 7-day rule that the IRS lays out when it comes to qualifying as a short-term rental. So what the IRS says is that the average stay for your short-term rental has to be 7 days or less in order to qualify as a short-term rental as opposed to a long-term rental and be able to write off a huge chunk of the value of that property against your active income. And so people kind of overlook this or don't think about what the average stay is, and that one long booking could throw that off. Also, people don't understand that you only need to hit that requirement in the first year. In the year when you're taking the huge bonus depreciation, which for most people, that's year 1, the average stay has to be 7 days or less. So you might have a property that works really well, especially in the off season. Like we have a lot that we rent out in the off season as midterm rentals, and people will stay for 3-4 months, and that maximizes our off season. And then we have shorter stays in the peak season, but that could mess up the average on those properties. So in the first year, you just want to cap the length of your stays. You could have one that's a couple weeks, that's longer than 7 days, but then you need to have enough that are shorter that the average stays less than 7 days. So I'm going to get into mistake number 5 in just one second, but I just want to mention that if this is helpful and you're thinking, I'd love to implement this strategy myself, but I need some help with maybe finding the right market, the right type of property that's going to be a really high performer, not just some random property that's going to suck every year after you get this big write-off and you're going to lose money on it every year and have negative cash flow, but have one that's a really high cash flowing property and you want help around setting it up the right way and managing it going forward. We have a very specific program that walks you through this entire process, where I work with you personally to help you through all stages of this and get a property that's going to give you that really significant write-off, and it's going to be a high performer and a big wealth builder for you long term. So if you're interested in that and you're interested in working with me through that program, you can go to the link below and you can set up a time with either me or a member of my team at that link and talk through your goals. And we can talk about the program, share the details of it, and see if it's a good fit for you. The 5th mistake that I see people make when it comes to this that really drives me nuts because it's so preventable is just using the wrong tax preparer or CPA. I just had a member of our coaching program reach out and say that they talked to their CPA about this, they're buying a property, and they said their CPA doesn't believe in this strategy. And like it's something you believe, like it's the Easter Bunny or something, like you believe in it or you don't believe in it. You don't have to believe in it. It's one of the biggest tax advantages that exists. So by not believing in it, that CPA is costing them tens of thousands of dollars because they're not implementing this strategy that they've already worked so hard to put in place. So it's really important to recognize that not all tax preparers or CPAs or tax planners are created equal. And some of them just might not understand this strategy or might not understand the rules that are required to implement this strategy successfully. So if yours doesn't, then I would just recommend switching to a different CPA that kind of specializes, because it's hard to know everything. I get it as a tax preparer preparer or a tax planner, you're not going to know absolutely every rule, but try to find tax planners and CPAs that specialize in that type of business. So if you want to implement this short-term rental tax loophole, find a CPA who works with others who have short-term rentals, and they help them implement this as well. So if you want a suggestion for one, we've got a link below to the real estate CPAs is what they refer to themselves as, because they really specialize in working with especially high income earners who want to implement real estate into their strategy. So there's a discount at that link to set up a call with them. They gave us a discount for our community. You can set up a call with them. You can talk through your situation, and they can explain to you exactly what you need to do in order to successfully implement this. Mistake number 6 that I see people make is they skip the cost segregation study at the end of the year. And this either can trigger an audit, or it can just, not provide you with the maximum tax benefit because you're making assumptions. So what a cost segregation study is, an entity will come in and look at your property, and they'll break down every component of that property into buckets. And so they'll say, like, these components of the property wear out quicker and they qualify for the big upfront bonus depreciation, and then these components don't. And it's not like straightforward where you can just say, 25% of my property qualifies for bonus depreciation. You have to break it down and see. And so every property is going to be a little bit different in terms of what qualifies for the bonus depreciation and what doesn't, based on how that property is set up. So things like, your furnishings and the appliances and the flooring and stuff like that, that wears out quicker. And so you're going to be able to write that off in year one with that bonus depreciation. But then things like the structural system, or maybe the plumbing system, like the big components that are long-term components, those aren't going to fall into that schedule. And so you're going to write those off over a longer period of time. So you don't want to guess on this. It's well worth it. There's really cost-effective cost segregation companies out there. And so I'll put a link again to a company or two that we've worked with in the past that have done a really great job and are really cost-effective. I mean, it used to be extremely expensive to get a cost segregation study done. Nowadays, with all the technology around it, it's a pretty straightforward, quick, and pretty cost-effective process. And the final mistake that I see a lot of people make when it comes to this is just not documenting. So the IRS is paying attention to this strategy, right? It's a new benefit, and a lot of people are implementing it, but a lot of people aren't doing it the right way. And it's not that people are necessarily trying to cheat the system, but they're just not organized. And so they're not tracking the amount of hours that they're putting into it. They're not doing the cost segregation study. They're not doing the things that they need to do in order to prove that this is a legit write-off if they were to get audited. So then they get audited and they have to pay back all of this money that they should have had as a write-off just because they don't have the right documentation in place. And so we help people who are a part of our program to kind of track this stuff and connect them with the right professionals to make sure they're doing things the right way. And it doesn't have to be overly complex. It can be a simple system. There's apps for it. There's, you can set up a spreadsheet even, whatever fits best in your lifestyle and your workflow. But I highly, highly recommend you don't skip the documentation aspect. So if you look at your pay stub and you see a huge amount being deducted every single month, so at the end of the year, this can be given and handed over to the IRS, buy a short-term rental. It just doesn't make sense to hand that to the IRS when this rule exists and you can go out and buy a short-term rental, and instead, all that money comes back to you at the end of the year. You can apply it toward your down payment to buy that property. And then you've got this property that appreciates and cash flows long-term. And I've interviewed, I think it's like right around 300 people on my podcast who are really successful real estate investors. And I ask them all the time, like, what do you wish you had done different? And the number one answer that I get all the time is, I just wish I had started sooner. Because people don't regret owning real estate long term. Like, if you buy the right property, yeah, you can make mistakes, and there's obviously horror stories and stuff, but if you are just smart and you follow some fundamentals and you buy the right property and you hold it long term, 10 years from now, you're going to be in a much better financial situation. 20 years from now, 30 years from now, you're going to look back and say, that was one of the best financial decisions I made. And it lets you keep all this money that you're making right now instead of handing it over to the IRS. So if you want help with this to ensure you don't make a mistake, you can set up a call with me, like I said, at the link in the description below, and we can talk through, whether my program's a fit for you. But even if it's not, I just encourage you to explore this really incredible tax deduction strategy because it's one of the best ones out there that exists. Thanks for spending time with me today. God bless, and I'll see you in the next video.